Morning, everyone. Welcome to this morning's edition of MPC Markets Morning Call, 6th of August 2025. Headline being weakening economy give investors cause to tap the brakes. We saw that momentum sort of sucked out of the US market after that really stellar rebound yesterday across the board in the US, which sort of dragged obviously our market higher to nearly record highs yesterday. I think it was a point or two shy or something along those lines. Was on the back of ISM Services, which is a economic activity indicator. They also do a manufacturing one. It came in at 50.1. 50 is neutral. Anything below 50 is contractionary. Anything above 50 is expansionary. We're expecting a 51.5. That's not a massive miss, but it's still very close to contractionary territory, which is what people would be broadly concerned about, I suppose, overall. But look, we were still positive in the Asian session, which, as you can see, reflected there, the ASX 200, the Nikkei, the Hang Seng, etc., all up, 0.7 to 1.3, 1.2, sorry. And very pleased with the Aussie market. It actually got its game on and was a bit bullish, albeit a couple of really spotty, results yesterday. Tealix in particular, massive overreaction to a 3% higher operational expenses. The Australian market overall, again, I think it's a bit of a scenario like JLG. Analysts are just not pricing it properly. That's the peril of having 6 monthly earnings as well, is that is realistically the updates are so far apart that the analysts maybe sort of lose track a little bit. But it was down 15% at one stage, which is absolutely absurd. It's still maintaining or just below its rule of 40 discipline. But coming down from last year at a rule of 40 of over around about the 70 mark, which even beat zero, for instance. All the company's doing is increasing operating expenses to expand geographically and expand their manufacturing facilities, which with what they're manufacturing, it has a shelf life. So those manufacturing facilities being close to where they need to deliver them to are essential. It's not EPS accretive necessarily. However, it's the right strategic move for the company in the long term, and and it's just a reflection of all the things I don't like about the ASX, and is that companies should be rewarded for taking a small breather and consolidating basically their position and their first mover advantage in this nuclear medicine space, and see the forest for the trees a little bit. But instead, as I said, for something that should have probably warranted maybe a few percent move to the downside, the stock opened down 16%. So, but good thing for us is great buying opportunity. Highly recommend go and have a nibble at those. I dare say on a 2-year basis, you'll easily double your money on them. They're a quality company, and they are coming into net profitability as well. Back to the US session. Fairly mixed there. As you can see, conservative sectors, sort of healthcare, technologies, and some of the transportation, process, healthcare, some of the cash flow kings were up. But obviously Palantir was up quite a lot. The world's most expensive company keeps on getting more expensive. And massive kudos to our head of US stocks and Global Alpha, Richard Nader, who basically skull dragged me into letting us recommend that one. I could not fathom how expensive it is, but it's been an outstanding recommendation for the clients since last November, and continues to be so. And and those defence names generally have done very, very well. Yesterday, particularly EOS in Australia was up 43% on $110 or $120 million contract win. And all of the defence stocks were up as well. So that's something we've been talking about for a while here at MPC. That's, to us, it was a bit of a laydown. And, we're starting to see even the ETFs at record highs and things like that as well. So that will continue, I would imagine. But AMD was the only one really. It reported after the bell. It was down 1.4% on the day session. It was dropped about 4%. Fairly poor income statement. Probably one of the worst ones I've shown you so far. Obviously not making money. Operating loss, the 100 million, and operating margins fairly thin. I think the market's just unfairly comparing it to Nvidia. It's not going to be the next Nvidia. It's the distant second to Nvidia, and I think the market probably had too higher expectations on it, truth be told. And it will play a bit of catch up, but I think that's probably more an insult to Nvidia comparing the two companies. They've been around a long, long time. AMD, they'll find a way. But revenue was up 32%, and 40% margins pretty good, and a 9% improvement. But no net profit, and in this space, the expectations are sky high for semiconductors. So I think what you'll start to see with these more traditional and old school companies like AMD and on semiconductors and things, the data centers are going to be built, and they've and really rolled out. So we're probably 6 months, maybe I wouldn't say 12 months, but maybe 6 months away from really starting to see that demand pick up for those sort of secondary devices, sensors and cameras and power monitors and memory chips and things like that. So you'd probably just have to be a little bit patient with these guys. Disney, McDonald's tomorrow, Uber, Shopify, Pinnacle shot the lights out overall, and sort of beat expectations on dividend, and earnings per share was about bang on. Profits were up like 49% or something like that, which net profit after tax 48.8% increase year over year. They've been getting a lot of FUM through the door, and that's the game in funds management, and they've been doing pretty well. So you'd probably expect them to do fairly well overall. And then we got a bunch of the REITs today as well. With I think we've got Centuria Industrial, REA Group, beat an increased dividend, News Corp as well, AMP, BWP Trust, and Charter Hall Long WALE REIT, which is one of the faves here. But yeah, then pretty slow start to earnings season. Commodities, well, hopefully that copper daily move drops off tomorrow or the next day, but there wasn't much activity overall. So pretty short one today. I don't expect the market to go too far. We don't have any economic numbers to really speak of. It'd be all eyes on iron ore, I suppose, during the Asian session to help that materials sector. And everything, I think things will be very stock specific, and sort of we'll go from there. But it was a good result yesterday with the Aussie pushing higher. Hopefully it doesn't taco and chicken out at the highs here and maintain some ground. But who knows? The Aussie market has a way of disappointing. So fingers crossed it can hang in there, and we'll sort of see some consolidation up here at record highs, because I think we deserve to be performing a little bit better than what we are. And I think we'll coming into earnings season as well, I think it'll be still very stock specific. But overall, what we've seen so far is that things aren't as bad, mainly at the company level. And the way we're probably going to play it is, our seasonality switch back to cash also plays into earnings season. That moves like Tealix's move yesterday seems to be the big opportunity in the Aussie market, because the analysts are just getting worse and worse. The consensus from the big brokers is getting worse and worse. Clearly their focus is not on Australia anymore. So anything outside the top 50 just doesn't, is sparsely covered. And you get really ridiculous reactions like that Tealix move yesterday, or Clarity Pharmaceuticals back in April at $1.60, which is now back at $5, or JLG, which got to $2, and private equity took it over at above in the $600 million higher. So that's where we're sort of seeing the opportunities is more so the weakness in the skill set of the analysts. They need to perhaps lift their game or stop covering some stocks because that anything outside that top 50, top 100, the coverage is just getting worse and worse, which is just causing these wildly volatile moves on high quality companies, which just tends to incentivize companies like JLG to go to private equity or good quality growth companies skip the ASX and go to the US like Canva. So it's a bit of a shame, but it is what it is, unfortunately. So sorry to end on a dour note. Hope everyone has a great day, and we'll speak again tomorrow. General advice warning. The content presented in this presentation is intended for informational purposes only and provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. This information should not be the sole resource when making investment decisions. We strongly recommend you seek the advice of a financial professional.